Okay, looks like we have some people rolling in. Just gonna let everyone kind of roll in. Maybe in the chat box, everyone could kind of drop where you guys are from, what part of the country, what you do in the real estate industry. And before I introduce our guest speaker, we could just give it a minute or two since we just went live for people to come on in. So real quick, just an introduction to SheFunds Academy. Really created this off of a passion of mine, just because I wanted a space for women to feel like they could come into a community, be able to ask questions, have mentors in this space, people that have been around doing it like Jennifer. So it's a pleasure to have a woman leader in the community available to give back. I always was always looking for a woman like me, someone who was paving the way, someone that I could talk to, I just felt like I lacked that so much starting in this industry. So this is the passion of SheFunds, is to really give back to women and give a free educational resource. As Jennifer knows, there's a lot of kind of cliquey committees within the private lending space, especially male-dominated ones, that it's hard to pave your way, or they just want to be greedy and you spend a lot of money to be a part of it, and they still don't recognize a lot of women in the space. So I just created this to be a free platform and to be able to give back in that way. But to get started and introduce our lovely guest that we are so grateful, Jennifer, to have you. I'll let you self-introduce yourself and take it away. Go ahead.
Hi, guys. I'm Jen McGuinness. I am the CEO of Pivot Financial. Janine, thanks for inviting me to be on SheFunds. One of the things I would add is eventually those boys that phased you out ask you to come back in. Um, but with that said, our business is a aggregation business that specializes in non-agency products. In non-agency products, that does include DSCR, bridge, fix and flip, and ground up construction, as well as some consumer-facing loans. We're also a rating agency approved due diligence company. We have a loss mitigation optimization business, a breach defense business, and a litigation support business. But I grew up in the investment banks, the funds, and the REITs on Wall Street, and have been in pretty much every seat of the full life cycle of these loans. In addition, when I say that I've been involved in DSCR and bridge and fix and flip since day one, I'm not kidding. The products were introduced in 2015, and I've been doing them ever since. So I would say, this is a discussion that has a lot of longevity to it. And I've been, handling these assets and dealing with these assets with our team since their creation.
I love it. I love it. We're very happy to have you here. I'm going to free flow the conversation and just, go from the title, right? The title of this SheFunds, we might have changed it 2 or 3 times, to be honest. But we landed with protect the house. And when you hear that term, especially I have some new people in the office in the industry, and they were like, kind of like, oh, what does protect the house mean? Does it mean the asset that we're lending on, protect that house, or protect the house as us, the lender? So I thought it was interesting to share the multiple perspectives, especially when it came to my mind. Protect the house means protect me, the lender, providing the capital. But I'm just curious of, that term, when you hear it, what comes to mind for Jennifer?
So protect the house to me means never assume, no matter where you live in the life cycle of the loan, that every decision you make is going to go exactly to plan, and never assume that every assumption you've made will be 100% correct, right? And when you think about it that way, then you can really assess what your risks are, your up and your downside, whether you're the borrower, investor, the lender, the aggregator, the servicer, the bond buyer, etc. And I think that's how I think about it. It also means that you always want to maintain liquidity. So whether you're a lender that sells loans to aggregators, or you're the person that owns these properties that are being financed with this type of lending, you want to always have liquidity. So you never want to enter one of these strategies assuming perfection, because it will not be perfect, I assure you. And you need to know when to, no pun intended, pivot accordingly in order to ensure that your risks and your up and down sides are always insulated, right? Another thing to think about is just because a loan goes bad doesn't mean the lender made a mistake. Life events happen, hurricanes happen. There are things that are outside of the control of both the investor borrower as well as the lender and a vast array of other things. But there is a lot that is also 100% in the control of all parties involved in this strategy as well. So protect the house means no matter what house you're in, always understand what your ups and downsides are.
And, coming from what you just said, I'm kind of hearing like equity is important, right? Equity is important on both sides of the equation. And that just kind of took me to a, off topic question of what you think, just Jennifer's perspective on the lenders that have done 100% financing. And what you think of that whole kind of niche, that some lenders go down that path.
Yeah, so I think, you have to think, especially being the investor, getting 100% financing, right? If anything changes, you're underwater, right? And unless you have a significant amount of rental income coming out of this property, well in excess of a 1.2, 1.3 DSCR, you're going to lose most of the time because any little metric that changes is going to be your problem to deal with. And
Yeah.
I think that's really important. Remember that the lender is originating to a set of guidelines based on the liquidity they have available, whether that's an in-house real estate fund or an aggregator or aggregators that they're selling a loan product to. So you want to also understand that a little bit better. What's the liquidity outcome for the loan that's being taken out? There are certain entities in the business that don't mind ending up owning real estate, right?
Mhm.
There are other entities in this business that don't want to own real estate. And I think the manner in which the guidelines are structured gives you some inkling to understanding what the ultimate strategy is in a default scenario or in a stressed scenario. I think also one of the biggest misconceptions on this is that borrowers will be treated just like a consumer facing borrower, as though these are primary residence collateral, and they're not, right?
Mm.
There is no loss mitigation requirement on these loans. It's an investor by investor mortgage servicing rights owner decision,
Yeah.
right? So 100% financing may not be putting you, the investor or the lender, quite frankly, in the best position.
Yeah, I could agree with that. And then what do you think too when, if you are a lender that is kind of lend to own and you're managing a bunch of assets that you've, foreclosed on and taken over, and it seems like a whole nother arm and department that you'd be onboarding with your company to pretty much project manage all of that and then try and sell them off. And it just seems like an extra job that you're going to have to outsource and hire. It just kind of leads me down the path of asking you what you think of the lenders that kind of create their own ecosystem. Like, is that something you would approve of? Like, say, I'm originating, I'm doing loans, and then all of a sudden I'm like, I'm going to come up with my own AMC company and I'm going to own that. And then on top of that, I'm going to own a servicing company. And then on top of that, Jennifer, I'm going to hire someone that manages our portfolio that, also takes on all of the ownerships that we oversee. Like, what do you think of the lenders that are going down that path? Because honestly, I'm seeing more and more of them. You work with this lender and then they have their own appraiser, own servicing, own this, and it just seems unethical. But then again, we're in a industry that is so like self-regulated. So when does that become too much, and when does that overall hurt our industry?
So I think owning other types of companies throughout the life cycle in and of itself is not a conflict. Where it
Okay.
becomes a conflict, and usually it is not allowed to be used, would be if, in fact, the lender was able to decide what the value was themselves, if, in fact, they're making decisions on data that's not arm's length, right? So, we have seen a rise in consumer facing loans, especially HEI agreements and certain HELOCs that are second liens, internal valuation models, right? So, no appraisal, just internal automated valuation models. I think that's a slippery slope. If you apply that in DSCR, which we've seen people do, it's an even more slippery slope because these are investment assets that will be actually occupied by tenants, and evaluation has to be considered that way as an investment asset. So your primary
Yeah,
residence
very
valuation,
interesting to hear you
yeah.
say that because, I wish that Sydney was on this call right now as a host, just because as our chief operating officer, she's dealing with a lot of the capital we sell our notes to. But more and more and more, we're seeing the internal value. And we're like, we provided an appraisal, we have provided a CDA. And then all of a sudden you're disregarding both of those. And then you have this internal value. Like, where is this stemming from? Like, so
So so that's, aggregators are not all created equal. There are some cute aggregators in this world, and if you have a legit, fully documented appraisal versus their automated valuation, your appraisal should be defensible, and you should be able to de-trigger the valuation model that they're in fact using. But, certain people will apply a discount that they didn't tell you about in your underwriting guidelines, and that's not okay. So I think also for lenders working with partners that acquire loans, you have to choose your partners. And some are saying they're your partner, but clearly depicting they're not, and some are true partners. So I think you really want to make sure that you're working with people that adhere to the guidelines they provide and stand by those. And it sounds to me that that may not be what's happening on those loans, but what I would say is, Sydney, bring me that loan or
Mhm.
loans, and I'm pretty confident the aggregator will end up buying those.
Amazing, amazing. So, for an investor building a rental portfolio today, where would you say is the real durable equity in the deal itself?
So I think there's two different kinds of equity. There's real equity, right, which is down payment and amortizing, principal of your leverage actually being paid down. And then there's appreciation of an asset. And I think they're very different depending upon if you're looking at an RTL product that's newly originated that's going to have rehab, or if you're looking at a DSCR product, right? In DSCR, generally we're going to have the valuations and reconciliations and all of that, but you have to realize that you're not getting 10% per year equity appreciation, from a home price appreciation perspective anymore. Those days are gone, and they weren't everywhere. You have to get to, and if you're modeling your deals on, a 5, a 7, a 10% per year appreciation rate, you're generally going to lose, except for select markets at this point, with how home prices have actually begun to equalize. The run up from COVID has come down. You've got an equilibrium now in the manner in which home prices have appreciated and started to chill. And then, you've even had 4 or 5 states that have really started to see some depreciation as well. So you definitely, when you're looking at, your investments and are we acquiring another property, et cetera, you don't want to be betting on large percentage appreciations from a home price perspective. You do want to be thinking about actual equity. So, real down payment cash, the amortization of the loan. There are interest only DSCR loans right now. Is that the best product structure that you should be using to actually, reach your goals from a cash flow perspective? You're not going to be paying down that principal balance. So if you're at that higher leverage scenario, if the market starts to correct and come down, you could be underwater very quickly. Certain other things that I think are important away from equity is, the investor is supposed to, in a DSCR loan, have the coverage to cover the operating expenses of the underlying property. You've seen the rise of guidelines now allowing, a zero point 0.5 DSCR, a zero point 0.7 DSCR. And you have to think about what that really is as the investor owner and also the lender. It means that the all in expenses of this property generally will only be covered 50% of them. So if it's $5,000 worth of monthly cost to operate a property, you're only going to have 2,500 of that covered. Where's the other 2,500 coming from? Right?
Hmm.
Do you have the capital elsewhere, et cetera? And should you really be investing in a property that can't cover the leverage that you're taking?
Yeah.
Because what are you really going to make on this property? It's an out of pocket scenario. And I think that's important as well. That property may not be the best rental candidate. That property maybe would be a better fix and flip candidate if
Hmm.
you really believe in that property and that market, et cetera, or it may not be a candidate at all. And maybe you need to move on or even out of the market that you're, sitting in and looking at right now.
Agree. And yeah, the DSCR constraints, I always advise clients, like, we're also protecting you and your investment, right? Like you said, do you want to be in maybe an interest only just because you're saving a little extra on the rate, or your monthly payment's lower because it's an interest only payment? However, you're eventually going to be underwater because you're not paying down the principal and you have to think bigger picture. So I always try and give people many options and make sure they're educated and walk them through that, because it is important. So for the people maybe very new, I saw someone chimed in on the chat. And by the way, audience, this community is built for you. So don't forget that. Like, yes, I'm firing away questions at Jennifer, but if you have questions, please ask it and don't be shy. No matter what the question is, even if it's what does DSCR stand for. So just feel free to chime in with any question in that chat box, and I'll make sure to see it and pull it up for Jen. So my next question is, maybe actually let's do one-on-one DSCR. What does DSCR stand for? What was it built for? You were the starter and one of the first companies that have sold the product. Where did it stem from? And then I'm gonna ask you a third part to this question, and that is, what is one thing people are still misunderstanding about the DSCR loan?
So DSCR stands for debt service coverage ratio loan. And, at the end of the day, it's a really sexy way of saying property based debt to income ratio, right? So it's principal, interest, tax, and insurance and HOA, if applicable, divided by rent. Sometimes those expenses or the rent have a haircut applied to them. It really depends on the underwriting guidelines. It's usually about 10% off the top, just to have some cushion. The debt service coverage ratio mortgage loan program was designed to be able to be qualified on rental cash flow. Prior to the DSCR and certain RTL products being created, the only real leverage that was available for these products was very large term portfolio loans, $5 to $500 million in size for very large rental investors that were more institutional in nature. But when this product was designed originally and brought to market in 2014-15, this was an 85% of all rentals were actually owned by landlords that owned 10 or less properties. So it
Mhm.
really didn't make sense that there wasn't a smaller loan or a loan by loan asset that was available. So that's why this product was designed. In addition, rental investors have a lot of additional income, but conventional loan products and other non agency products don't always serve the investor best or limit the amount of properties that you can finance without taking into consideration the cash flow. So a 50 DSCR is actually contradictory to what this product is supposed to be, because the whole point is in not underwriting the principals of the entity personally based on their own income. It's supposed to be a property based income underwrite to qualify. If that DSCR is 50, your property based income does not technically cover what it's supposed to cover. And as an investor in a rental, you shouldn't be going out of pocket. you should be making surplus cash outside of the operating cost of the property, because the entire thesis should be making money, not spending money, right? So your cash flow from the property should not only manage your normal operating expenses, but it should also be sufficient enough for if the property sits vacant for a few months. It needs to be turned over. What happens if a hurricane happens? If you're an investor in Florida and a tree falls on the roof and now your tenant can't occupy for
Hmm.
X amount of months, the insurance on these properties and the rent loss coverage only covers so much, but not everything, right? So I think you want to consider that. So I think that answers your DSCR 101 question, why the product was created. What was the third one? Did I answer it or was there another one there?
I think, yes, tell me if you did answer it, but it was what were people misunderstanding?
Yeah, I mean, one of the biggest misconceptions about DSCR is it's a no doc loan. That's not true, right? And no doc is really a consumer facing mortgage verbiage, right? This isn't a no doc loan, it's a different doc loan. It's also a loan that is created for a business purpose, right? So if you're going to take out this loan and then move into the house, that is not a business purpose. These loans are supposed to be given to entities, not humans. There are some aggregators that allow for the loan to be given to a human. The LLC, LP, revocable trust, etc. And then the guarantors behind the assets are, generally the guys that own the business 51% or more, but they're not ignored, right? There's still a credit score component to this underwrite. There's a cash flow component to this underwrite. There's a consideration of, is there a real lease in place and what does that rent look like versus the market rent for a similar asset? There are allowances to have vacant properties, but then there's, other ways to qualify with anticipated rent. This loan was also created to be the takeout loan post a rehab if you're doing a rehab on a property to rent. So just like there's fix and flip to sell, there
Mhm.
is a fix or a rehab to rent loan component as well. And the thought process with the DSCR was do an acquisition bridge financing or an acquisition rehab financing. Once that rehab is completed and the property is leased up, then convert into the longer duration financing, which is generally cheaper from a rates perspective to have that longer duration financing. So the real thesis when these products were designed were really giving the cash flow product leverage at all facets, the acquisition, the stabilization, the refinance, et cetera, et cetera.
Yeah, love that perspective. Where do you see investors taking on risk they don't realize they're taking on in the loan structure, the property, or the assumptions behind the numbers?
Yeah, so I think, again, you don't want to be betting that every assumption you make is 100% going to work all the time. And I think a lot of investors, especially those that rehab properties in need of repair, do not consider certain things. So, for example, if you do a heavy rehab loan, and let's say you're going to do that heavy rehab loan, whether it's to sell or whether it's to rent, right? You also, yeah, you're going to have an as repaired value. But that as repaired value is only as good as if you do everything perfectly and perfectly on time. And
Hmm.
every assumption considered during the origination of the loan is exactly right. Okay. One of the reasons why I counsel people to always build a contingency into a budget is generally none of it is going to be exact, right? And you need to have that extra cushion in that budget. But even in the DSCR component, if you did rehab the property, your property is going to get reassessed. Even if you just, did a siding and a new roof on the outside, put in a new kitchen and let's say added a finished basement, at some point the assessor is going to get into this property and your taxes are going to go up, right? And when those taxes go up, if your assumptions were made on the taxes today, you're going to be in for a rude awakening. In
Hmm.
addition, property insurance
Especially
has
on
skyrocketed. What'd you say?
especially on new construction.
1,000%.
Yeah.
The other thing is property insurance, whether it's for an investment, a second home, a primary residence, has skyrocketed generally across the nation. And a lot of the reason why that's happened is because a lot of state regulation didn't make sense. So, climate issues, fires, things that happened in different markets, have now trickled through the rest of the nation where they may not be relevant just to pay for the things that the underwriting of the insurance, could not recoup elsewhere. So it's now, going through the market. We also have some unregulated states. So today, if you're buying investment property for rent that you plan to hold, you need to build cushions into what your expected numbers are for just operating expense to begin with. But then you also have to assume if you're going to hold this for a longer duration of time, right, that something is going to break in these
Mhm.
houses, right? Remember that your tenant is not generally most of the time responsible if the water heater dies
Yeah.
or your tree falls on the roof, et
Mhm.
cetera, et cetera. So you have to have reserves for that. And I think that's important as well.
Love it. I haven't seen any questions yet, so I'm just here to remind you guys if you have questions, comments, anything at all, if you even just want to introduce yourself, where you're from, and what you do in the real estate industry, feel free to drop that in the chat. But I'm going to keep my questions going for Jen.
Well, I would also throw out there if there's a question that we're not touching upon
Yes.
here with regard to this product, the life cycle, et cetera, ask that too, right?
Yeah.
Because we can answer it.
Yes. And I want to dive kind of into one, kind of ask you what you're seeing so many of the, the origination side, the funding side, the closed side. One, which phase of the cycle is Jen's favorite? And then my second part to that question is kind of on the 101 of servicing and the closed phase. A lot of, originators like myself have only been on the front facing side. So kind of walk us through the whole aspect of a loan when it is done origination with originating, what that looks like.
Yeah, and I'm gonna parse it by product, RTL products versus DSCR products. DSCR products look a lot more like a regular mortgage loan,
Hmm.
30-year, fixed arm IO, escrowed or non-escrowed, et cetera. But what makes it challenging for the standard servicer to board those loans is that generally the servicing systems were not created with entities. They were created for humans, okay? And you have to actually know that the borrower here is an entity, right? So entity name should be your borrower, then you should have guarantors. The servicer should understand who's responsible, but there's also different metrics in these lending instruments than standard mortgages, such as, um, default interest rates that are higher, minimum interest collections during payoffs, the allowance that loss mitigation doesn't have to happen, and things like that, that an investor should really understand before they're taking out these products. But data coming from the lender or aggregator that's setting up these loans with the servicer needs to be clean the first time. I also say the best interest of the investor is being on ACH. Okay. So, auto payment, but you have to also understand that if the servicing of your loan transfers, you need to set up that auto payment again with your new servicer. Even consumers that own their primary residences don't realize that. So you can end up in a delinquency, not even knowing you're delinquent because that ACH could have ended. RTL products are way more complex from a
Hmm.
servicing. And right now, for these, I'm just focusing on onboarding, post closing. We'll talk about default in a minute.
Yes,
Um, but the
please.
RTL products, two different kinds of interest metrics. Is it Dutch? Is it non Dutch? The servicer is setting the loan up incorrectly means that the investor is being charged wrong. Is everything advanced? Has the loan been 100% advanced, or is there an escrow holdback? Is there an ongoing budget management component to that? The draw advance asset management and how that is set up is the difference between your borrower, which is your investor owner of these properties, coming back to you for your next loan or not. It is the difference between getting the project done on time or not, for example. So, setting that up from the get go correctly. The final budget. There's an iteration that happens in the RTL product when you're doing ground up construction or light, medium, or heavy rehab. That budget changes during the time of underwriting, and you want to make sure that the final budget that the loan is truly based on is what the servicers are setting up. We actually are the asset manager, not only for our own loans, but for a vast array of loans for third parties, because we automated the draw advance asset management process. Like, it doesn't have to go to Bill, to go to Susie, to go to Jim Bob, to go to whoever to manually sign off on things. There's literally a human touch reconciliation at the end of the entire process. The
Mm.
reason
So
that
your
draw
company originates and asset manages?
So our company aggregates. So we buy closed loans and we're an asset manager, right? So because we have two totally different silos to the business, but you want to think about you need the borrower experience has to be good here, right? This is a business. If you showed up to work and somebody said to you, "Sorry, I can't give you your paycheck this week because I forgot to order the inspection, wait another week and a half and you had bills to pay." Is that going to be disruptive to you as a person? You have to think about that. It's just as disruptive, if not more, to a business, right? So I
Mm-hmm.
think you need to think about that. The other thing is having a mechanism that's defined with the investor up front during origination. Where do they ask for their next draw? How is it reviewed? What do they need to do to get that next round of money? How does this process really work? And education is important, and servicers are not that great at educating people. So I think that's important as well. The more you set your investor borrower up to succeed, the better outcome they're going to have on these loans, right? Um, Other things. Default on these loans is not, look, we got a question here. If a client
Yeah.
gets behind on payments and the interest jumps because they're in default, do monthly payments go back to normal? If they bring the loan completely contractually current, yes. So there'll be default interest collected during the actual default period. If the borrower brings the loan completely current, then they would revert back to
Meaning
the original
paying
interest
all
rate.
of their default and paying
Correct.
that to
So
current.
all default and so default principal and interest, and if it's an escrowed loan, taxes and insurance,
Yes.
plus any default interest paid in full, right? Now the loan's really contractually current, then yes, it will go back to the original rate.
Good
One
question.
caveat to that would be if it was in an arm adjustment period, and then it wouldn't be a fixed rate. And if it were in an arm adjustment period and they had another adjustment, it would be the regular contractual rate adjusted the way it's supposed to be.
And if someone had a ton of default, say they missed 3 payments, so they have added a lot of default interest, is there an option to raise their monthly payment rather than having to pay it in a lump sum?
So it's all dependent upon who the owner slash investor is of the right to service these loans and the loans themselves. They're going to make that decision because that's what's allowed in these products. I
Took one question and we got a bunch of questions rolling in now.
I would say that the answer is most of the time the servicers are directed by the investors to work out the assets, right? However, if you're a perpetual defaulter borrower, you're going to find that at some point you will be foreclosed. And foreclosing these properties is a lot faster than foreclosing a property that is a standard resi loan. Why? Because the structure of the loans themselves have safeguards in them. For example, confession of judgment, the pledge agreement, right? And a vast array of other things.
Mhm. We have a few more. We have like a lot of questions actually
So
coming
let's
in.
do it. Let's do the
So,
question.
but one quick question. How does someone onboard with Pivot Financial and like to get you to buy some of their loans on their books?
Yeah, I mean, so we're a non-dele and delegated correspondent. So you go through a correspondent review. Assuming that you meet our eligibility criteria, then you would get rolled out like any other
And what does that
correspondent.
look like with some people? Like, what does your criteria of checking that box look like?
Yeah, I mean, our criteria basically, in order to be eligible to work with us, you have to have at least a $2 million minimum net worth and a couple of other requirements. We do work with business purpose only lenders and also, consumer facing lenders that also do these loans. So I think that's important. But what I would say is we are aggregating. We do not, give you your warehouse line. We don't give you like everything. There are certain aggregators in the market, to Janine's point earlier, that try to spin that like being your warehouse provider, plus you're this, plus you're that, plus this is in your best interest. You really need to understand the details behind that. That's not necessarily always in your best interest.
Agreed. Okay, next question. Question, ladies. Our firm specializes in working capital and LOCs for business owners typically after the bank declines them. Most of these clients have real estate. Do you think there is an
Opportunity for
opportunity
what? What's the other piece?
for us to refer some of the clients your way?
Yeah, I would say as they repair the decline reasons, right? And they start to equalize back to their portfolio, or they've figured out what those stress points are. Happy to talk about scenarios here too, if you want to throw one into the chat. Um, the answer is yes, there may be an opportunity to, refer loans to simple lending, for example. But they would have to have cleaned up whatever the reasons were that they were getting declined previously.
Yeah. Feel free to drop your email or contact info, Lori, and we could definitely connect
Yeah, and
as
Lori, if you want to throw a scenario in here, we could totally react to that too.
yeah, down for that. Next question's from Courtney. How do you calculate when paying additional points to reduce the interest rate actually improves the investment's IRR rather than just making the monthly payments better?
All right. So the sad reality is you're not going to want to spend the amount of money that's really going to enhance that IRR enough to matter on these products, right? Taking a point off the interest rate on these products is not going to make your IRR so much better that you're going to make or break the decision on if you want to invest in an asset.
Yeah, but some investors, man, they're so keen on like that 7.99 instead of the 8% rate, so they'll pay those extra points.
Yeah, and I think what you need to do in that scenario is open up an amortization table and explain to them that we're talking about less than, we're talking about little dollar amounts. I did an analysis recently, for example, taking a loan down, by a couple of points, and I think the monthly payment deviation was $82. Like nobody's going to be super excited about $82, and it's not going to be enough for your IRR. And if your IRR is so tight that $82 makes a difference, shop for a new property.
Yes, agreed. Agreed. Okay, next question's from Vanessa. How are we handling those investors using DSCR loans as assumable?
I think we would need a scenario, meaning a DSCR loan that can then, like through the wholesalers, be transferred to the new investor owner. I'm guessing is the scenario, Vanessa, you're talking about.
I would believe
Yeah.
so. Yeah.
So I think you want to think about if you're the guy or girl assuming that loan, right? Do you actually want to take on the credit risk of somebody that's not you? So the loan was in fact underwritten, decided, structured, etc., by a different investor. If your investment thesis is not identical to theirs, the leverage scenario that's on that property may not actually be enhancing your investment. And these loans are still underwritten for an assumption where assumptions are allowed. And the only reason you would want to take out an assumption most of the time would be if you were less bankable. So it's not going to get approved most of the time because you still are going to have to meet the qualifications to have the loan.
Okay, Vanessa said selling to primary.
The DSCR loan should not be assumed by a primary residence occupant.
Okay, is that all the questions or we got more questions? I feel like DSCR is kind of like the hot topic we keep going back to here.
Yeah, and I want to just say, Vanessa, one other thing is why should a DSCR loan not be assumed by a primary occupant? Because it would be a misrepresentation. So the person assuming the loan would actually have to attest that the loan was being used for a business purpose. And that wouldn't be true because they were going to occupy as a primary residence. Make sense? All right.
If someone owns 2 or 3 properties right now and they want to keep scaling and growing, what could they put in place with so they're not overextending themselves?
Well, I mean, first you have to figure out if you are overextending yourself or not, right? So, what I would say is the first thing is you have to stress test the assets that you own, right? So, first and foremost, what happens if there is a valuation decline of 5 to 10%, an increase in your taxes, homeowners insurance, and you have 3 months of vacancy on all three of the loans that you or the properties you already have? And let's say we are thinking about adding a fourth, right? Do you have the capital to actually cover that stressed scenario? And the stress scenario that I just depicted is a light stress scenario. It's a very realistic, could happen scenario in the market that we sit in today. So I think that's the first thing. I think, other things are, why are you buying the fourth property? What's the thesis, and is it shifting your portfolio concentration? For example, you have two single families, and now you've decided because you bought 1 2 to 4 family that you'd be better off invested in 2 to 4 families, right? And the question really is, do you need to buy that fourth property, or would you actually be better off trading out of one of your single families to actually free up the cash to actually buy the new 2 to 4 family property? So I think portfolio concentration, portfolio stress testing. um, Leverage is not a execution strategy, it's a financing facility. So if you are 100% dependent on the money from the loan to actually just keep your portfolio afloat, then you should not be managing the portfolio you have nor adding to it, right? You should be using this as a conduit to increase your cash flow. And if you're finding that you're net flat or net negative on a monthly basis, whether it's from one or more of the properties, then you should actually first actually focus on, you know, getting rid of the property that's negatively accretive, and then making sure that your positive cash flow to the right level that you need to be in order to take on another asset, right? And again, where's your reserve account for the three that you have and whatnot? The other thing I think that's important is, what is your actual strategy, right? The reality is, I say this with love, nobody really wants to manage a whole bunch of tenants, right? The strategy really should be, I can make material cash flow off of this property from rental cash proceeds. Or this may not be a rental candidate. Maybe then you're in an RTL fix and flip scenario, a build scenario for sale, a build for rent scenario. But again, pick your markets accordingly. Um, and I think variable debt. So you also want to think about your rates and your payments. Okay. DSCR for a long time was 30-year fixed only. Okay. Now there's ARM DSCR. Well, ARM means adjustable rate mortgage. Okay. That means that at some point during the duration of your mortgage, the DSCR loan, your rate is going to change. And generally, in the market that we sit in today, it's not going down. Most of these documents for ARM loans will also say that the minimum rate is your starting rate. So that's going to be the best rate you're going to get most of the time. The only place really for that rate to go would be up. If it goes up, your payment's going with it. Okay. So do you want a static payment that is payment from a principal and interest perspective certainty? And then really your only variables would be your taxes, insurance, and HOA if it's applicable, plus any repair, blah, 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 right? But, or do you want to fluctuate and all of a sudden, the interest rate goes up 2 points, 2% more than what you're paying now. And now you've got a principal payment that's going up and an interest payment. The principal's standardly the same, but generically it's going to go up a little. Interest that's going to go up. And now you're carrying, more capital than you really signed up for in the beginning. So I'm a big fan of fixed rate DSCR. The other thing is interest only. Make sure you understand what that means. That means that the principal amount of the loan that you've taken out is not going to change unless you make a principal pay down payment. But that is not your regular monthly payment. You're only paying interest. So if you started with a $500,000 DSCR loan, when you go to pay it off, it's still a $500,000.
Wild.
And that's an issue, especially at that higher leverage ratio. Janine brought up 100% financing. Well, if you took out a $500,000 loan on a $500,000 property and the market starts to change against you in valuation, not only will you be paying that 500,000 when you go to sell, but you'll also be making up usually the gap, because you won't have enough proceeds from the sale of the property to actually cover what it takes to pay off the loan. That also brings up another point. You should always be modeling the cost to sell into your property acquisitions. Brokers don't sell houses for free, okay? Neither do wholesalers. They all get paid fees. So you want to think about, when you're thinking about those higher LTVs or LTARVs, right? That you're going to, when you sell this, have to pay fees to sell the property. Okay. So you want to take all of that into consideration. Also, you like the rate, you believe they might go down, maybe they will, maybe they won't. Well, if you originate a new loan, you're also paying closing costs to close that new loan. So you want to make sure that your strategy is not dependent upon refinanceability either. Markets can swing, characteristics can change. So just because you can get 100% financing today doesn't necessarily mean that that's going to be available a year, 3, 5, or 10 from now. It's all about market and timing for investors.
Love it. You make the hosting job very easy because your your answers and the information you have is endless. So we have about 10 minutes left. So if anyone has any final questions, I do want you to share. I have to say, this hasn't been our most attended webinar, but everyone that's joined this call has been with us from the beginning. So it's the most engaged audience we've had. So I know Jen's spitting some facts. So I do want to give an opportunity for any last final questions. And I thought maybe it'd be a good time to Jen, to share your LinkedIn page where people connect with you, maybe drop your email on this chat box. This way people could definitely connect with you as well.
Yeah, I mean, my LinkedIn profile is really easy. Just put in the name you see on the screen, Jennifer McGuinness-Lubbert. With regard to my email, I'm putting it in the chat right now. Actually, I'll just put it on my name on the screen if I can, make it easy for everybody. And it's very difficult. It's the name of my company. So it's jmcguinness@pivot.financial. So if you have questions or you think we can, enhance your strategies, we're very happy to chat with you about that.
That's awesome. And then Sydney also dropped our WhatsApp group. And I want to just have everyone join that if you can. Like I said, this is a community that is really based around you guys. So the more we connect, the more you guys let us know what kind of webinars you want, and what you want to hear and things you want to learn, the better we can assist and make all of this education to you even better.
I think the other thing I want to say is, Janine said she started this group for women in the business. Are there women taking part in this call that have questions about, how to either grow a lending business if you're an investor, being a woman in this business as well? We're clearly both women. We can give you, a story about, and, quite frankly, facts about what it takes to succeed in this industry.
Yeah, and I would love to even hear some of your perspective, Jen, too, on that. Being a dominated player in this industry and a woman, like maybe some obstacles or things you've leaned on that would be advice to women just getting started. I do have another question here for the women in this room that are building and maybe it's their first investment property and things like that. Even advice or other communities that you think are resourceful, all of that's a good, time to drop that as well.
Yeah, so when I started out in the industry, just generally, I was literally the only woman, right? I think the only other women that were even there were administrative assistants, and I was sitting on a trading desk with, 1,000 men, and I grew up on a Wall Street trading desk. It's been many, many times in my career where I've literally been the only woman in the room. Still happens to this day, believe it or not. And I think you need to have a certain level of confidence to be okay with that. I think what really helped me was remembering that we're just all people. Who cares if they're male, female, etc.? We're just people in the room. In addition, half of the things that are going on in your head are only in your head. So the sooner that you can de-trigger your inner dialogue, and find the zone of how you do that, the better. I psyched myself out a lot when I was younger, going, "Oh, I'm young. They're not going to think I'm taking they're not going to take me as seriously. I don't know as much as they do, or whatever I came up with in my own head." The minute that I started ignoring that and started opening my mouth to actually talk about the things that I had learned, understood, etc., I became a resource for those middle managers and super senior managers. And all of a sudden, that was what was starting to bring the trajectory of my career forward. I was one of the youngest directors on Wall Street who was a woman. There was only two managing director women that existed back then. There's a lot more today. But quite honestly, if you look at the CEO percentage across private lending, and just financial services in general, it is still too low. But there are a lot of women in CEO and executive management today. And I think that's really important. As it pertains to a woman that wants to run an investment property business, during the housing downturn, I was a property investor. I owned 19 rentals in Arizona, really, underwrote those. And, I still dabble in rental where I see it to be advantageous. So I think, you know, learn what has burned others, right? Learn what the mistakes were. What were the things? Talk to more experienced investors or people like Janine and I, or Sydney, for example, and say, what has gone wrong? What are the things that I'm not thinking about as I go to make my first investment into a rental house? And what are the things that I'm signing up for if I use financing to actually make that purchase? And understanding that is not as easy as Chat GPT. You have to have the real world feedback on that as well, because Chat GPT is only going to be as good as the question you ask it. And some of the time it gives you the wrong answer. So make sure you're always asking for sourced information if you're using AI resources, but you're actually better off talking to people with the real boots on the ground in the business experience.
Yeah, and I gotta throw a buzzword now that you've used it. Where do you see AI taking this industry if you were to give any future projections? And is there AI being used in your underwriting models in-house in Pivot Financial? And what are you doing with AI, if any?
So we use certain automation techniques and AI, but we don't use it for making final credit decisions of any kind. We've used it more so for process optimization, going through and, stacking documents, finding the characteristics of loans, things that, humans are checking or we're getting a confidence level in that they don't need to be checked by humans. There's a reason why, the disruptors that were automating underwriting still haven't gotten it done. And it's generally because the techies and the people that really do the jobs never really partner efficiently to get it done. I can do it better, but I don't know the details problem, right? And so I'm not going to say that I don't use AI. We do use AI. Our business uses AI, but we've always been tech forward. We've even been a top 20 fintech innovator, although we're not a fintech company. So there is a time and a place for all types of automation and technology, but it needs to be applied properly and in a way that's not going to cause you more risk.
Yeah, I like that. And yeah, just going back to what Jennifer said earlier, I think when, I took the step and was starting to do public speaking and, started a podcast, and public speaking was always a fear of mine. And I always say, the gold is on the opposite end of the thing you fear the most. It is when you develop that self-confidence in yourself, it kind of then on the outside attracts the people, and you gain more respect when you're educated speaking and not afraid to speak your truth. So I always encourage women to feel free to ask questions, stand up and make your space, whether you're negotiating a deal or an investment property. Just speaking your mind will get you many places. So I'm hoping that this webinar was a major resource for you guys. I did drop Jennifer's LinkedIn link via the chat. We're also going to share the RSVP emails. So I'm sure she'll maybe do a nice email to you guys. This way you have her contact directly if you need it. Her email's right there as well. We really want to make sure that we're being a value resource to everyone. And thank you so much for being a part of SheFunds. Thank you, Jennifer, for being here. We appreciate you.
Thanks for having me. And guys, if you have questions, feel free to, IM me, DM me on, LinkedIn or shoot me an email. And Janine, thanks for inviting me.
Thank you, guys. Have a good day.
Have a good one. Bye.
Bye.